Welcome to the Deep Dive. Today we're jumping into the latest from Siyaram Silk Mills Limited. They released their Q2 and H1 FY26 numbers, plus some big strategic moves back on November 4th.
That's right. And there's a lot more here than just the usual results. We're seeing signs of a real strategic shift and some pretty unique ways they're rewarding shareholders too.
Okay, so what's our plan? We've got the financials, the press release, the investor deck. How are we tackling this?
Well, our mission really is to cut through all that. We want to get beyond just the numbers from the quarter ending September 30th. We need to figure out, what's actually driving the growth, what's the thinking behind their new retail brands, and how this slightly complex shareholder bonus actually plays out.
Right. Let's start with the headline figures then. The Q2 and first half results. What's the overall picture? Looks like pretty solid momentum from the growth percentages.
It really does. If you look at Q2 standalone, total income hit about 743 crores. That's up over 18% compared to last year. Solid top-line growth, definitely.
Yeah, 18% is good. But you mentioned profits being the real story.
Exactly. Because look at the operating profit, the EBITDA. That jumped over 31%, up to 145 crores. And the profit after tax, PT, wasn't lagging much, up more than 27% to 87 crores.
Wow. Okay, so profits growing way faster than revenue. A 31% jump in operating profit compared to 18% revenue growth. That's a big gap.
It is. And that's the first big clue for you listening in. It tells you they're not just selling more stuff, they're doing it more efficiently or selling a richer mix.
Right. So what does that look like in terms of margins? That must be where the improvement really shows up.
Absolutely fascinating here. The EBITDA margin improved by 193 basis points. That's almost a full 2% jump. It went from 17.5% last year to 19.5% this Q2.
Nearly 2 percentage points on the operating margin in 1 year? That's huge.
It really signals something significant: better pricing, better product mix, maybe tighter cost control, probably a bit of all three.
Right.
And the PT margin also saw a decent lift, up 84 basis points to 11.7%.
Okay, and does this hold up when you look at the first half of the year? Is this momentum consistent?
Yeah, the trends are pretty much aligned. H1 total income is up 19%, EBITDA up nearly 23%, and PAT up around 14%. So yes, it looks like sustained improvement across the board for the first 6 months.
Okay, seems like a strong performance overall.
It is, but, and this is important, we need to flag something here we'll come back to. While profits are up, the cash flow from operations in H1 was actually negative, minus 513 million rupees, roughly. Compare that to positive 1 billion last year.
Negative operating cash flow. Okay, so growth is strong, profits are strong, but the actual cash generated from the day-to-day business was negative in the first half. That's interesting.
Exactly. High growth often eats up working capital, so it's not unheard of, but it definitely raises questions about funding that we need to keep in mind.
All right, good point. Let's park that for now and dig into what's driving the performance, what's the breakdown, where's the revenue actually coming from in Q2?
Well, the core business is still very much fabric. That accounts for 77% of the Q2 revenue. Garments are next at 15%, and then yarn and other bits make up the final 8%.
77% fabric. Okay, so the success really hinges on that segment performing well.
Absolutely. And if you connect this to what management, specifically Mr. Gaurav Poddar, the executive director, is saying, they point to a couple of things. One, just generally good consumer demand. And two, critically, the timing of the festive season this year. It started earlier, apparently, which really boosted buying sentiment. So they saw higher volumes and better price realization.
Better realization, meaning they sold higher price stuff or just got better prices for the same
It's
stuff.
likely a combination, selling a more premium mix or perhaps having stronger pricing power in the market during that peak demand period.
Okay, so the festive season gave them a nice tailwind. But that margin expansion, the nearly 200 basis points, that can't just be the festive season, right? What are they doing internally?
No, you're right. The company explicitly credits optimized product mix and cost efficiencies. Given fabric is the big chunk, this suggests they're either making their standard fabrics more cheaply, perhaps through scale, or they're successfully pushing more premium, higher margin fabrics, or, both.
And the fact that realization improves suggests customers are actually buying into that higher value.
Exactly. It supports that idea.
So looking ahead, what are they banking on? Just more of the same, or are there other factors?
They seem pretty optimistic. They expect consumer demand to stay strong, helped by rising incomes and just general economic stability. But there's one specific external factor. They highlighted the recent GST rate cut. Management seems to think this will give another little kick to consumer sentiment, especially for discretionary things like apparel. So they're positioning to catch that wave.
Okay, interesting. So, solid core business performance, helped by timing and maybe some structural improvements. But now let's get to the really, really interesting part, the strategic stuff. They're pushing hard into new retail, aren't they? Z-Code and Devo.
Yeah, this is where you see them trying to build like Siyaram version 2.0. They're using the strength of their established brands, Siyaram itself, J. Hampstead, Oxenberg, Cadini, as a foundation to launch these entirely new retail concepts aimed at different market segments.
And they're not messing around with the rollout. How many stores did they open just in Q2?
7 new Z-Code stores and 2 new Devo stores, just in the second quarter.
7 plus 2. 9 stores in 3 months. Wow, where does that put the total count now?
That brings them to 23 Z-Code stores and 12 Devo stores operational as of the end of September.
And what's the plan for the rest of the year?
They're sticking to their target, aiming to open around 35 new stores in total across both brands by the end of this fiscal year, FY26.
35 stores in 1 year. And you mentioned earlier this is all funded internally.
That's what the report says, all funded through internal accruals. No external debt or equity raised specifically for this. Which, going back to that negative H1 operating cash flow, it shows immense confidence, or perhaps pressure, on their existing cash generation.
Definitely something to watch. Okay, let's break down these two brands. Z-Code and Devo. They're quite different, right?
Very different, almost polar opposites in their targeting. Z-Code is their play in fast fashion.
Okay.
It's aimed squarely at Gen Z. Think trendy, quick turnover, and a really sharp price point. Everything capped at 999 rupees.
Sub 1,000 price point, aggressive. And where are they focusing geographically?
Primarily South India for Z-Code. That region often leads in adopting newer, faster retail formats. And look at the store sizes, 4,000 to 10,000 square feet. These are big boxes.
10,000 square feet. That's huge for fast fashion. Definitely aiming for a destination feel.
Exactly. High volume, high visibility, targeted the youth in the South.
Okay, so Z-Code is volume, youth, South, big stores. What about Devo?
Devo is completely different. It's ethnic wear for men, targeting the mid-premium segment. So not high fashion, not bargain basement, but quality traditional wear.
Ethnic wear. Interesting niche. And the geography?
North India, capitalizing on the stronger regional demand for traditional clothing there.
Yeah.
And the stores reflect the different focus, much smaller, 2,000 to 4,000 square feet. More like a boutique feel for that mid-premium customer.
Right, a more curated experience. Okay, that makes sense. Two very distinct bets on future growth segments. It's quite a comprehensive strategy.
It is, covering fast fashion for youth and mid-premium ethnic wear for men, alongside their core fabric and existing garment brands.
All right, let's shift gears to the other big news from that November 4th board meeting. Shareholder rewards and corporate changes. What happened there?
Okay, first up, the simple part. They declared an interim dividend, 4 rupees per share.
4 rupees on a face value of 2 rupees. So that's a 200% dividend payout.
Yep, 200%. Straightforward cash return to shareholders. Record date was November 11th, and the payout should happen on or after November 19th. Quick liquidity for investors. Cost the company about 18 crores.
Got it. Standard dividend declaration. What else? There were some personnel changes.
Yes, some key management personnel, or KMP, changes. Sri William Fernandez, who was the company's secretary and GM legal, is retiring. His retirement was approved, effective mid-November, though he'll be relieved in February.
Okay. A planned retirement. And they've named a successor.
Yes, Sri Mahipal Thakur has been appointed as the new company secretary and compliance officer, also a KMP role. That's effective from November 15th, ensuring a smooth handover of those crucial governance functions.
Right. Important for continuity. Okay, now, the big one. This bonus preference share scheme. CNCRPS. Sounds complicated. Can you break that down for us?
Yeah, it's definitely not your standard bonus issue. It's quite a piece of financial engineering, as you said. Basically, instead of giving shareholders more equity shares, they're giving them preference shares.
Preference shares. As a bonus, how does that work?
They're using their reserves, about 318 crores worth, from retained earnings or general reserves. They're creating these special shares called cumulative non-convertible redeemable preference shares, or CNCRPS.
Okay, cumulative, non-convertible, redeemable. Let's unpack that.
Right. Cumulative means the dividend, which is set at 9%, has to be paid. If they miss a payment, it accumulates. Non-convertible means these shares will never turn into regular equity shares. They stay as preference shares. And redeemable means the company will buy them back at a set time in the future.
So shareholders get these bonus shares, which pay a fixed 9% dividend, and the company promises to buy them back later.
Exactly. It's structured in 2 series. For every one equity share you hold, you get 4 Series 1 CNCRPS, worth 10 each, and 3 Series 2 CNCRPS, also 10 each.
So 7 preference shares in total per equity share.
Correct. And the redemption is staggered. Series I gets redeemed, bought back by the company at the end of the 3rd year. Series 2 gets redeemed at the end of the 5th year.
So why do this instead of just issuing more equity shares as a bonus, or just paying a bigger cash dividend?
That's the key question, isn't it? Well, a few potential reasons. One, it rewards shareholders significantly using those built-up reserves without diluting the existing equity base or changing voting control. Everyone gets the preference shares, but the underlying ownership structure of the company doesn't change like it would with bonus equity.
Okay, avoids dilution. What else?
It also provides a very clear, structured return. Shareholders know they'll get that 9% cumulative dividend, and they know exactly when the principal will be returned, 3 and 5 years out. It's less volatile than relying on the stock price performance of bonus equity shares. It's kind of like the company giving shareholders a fixed-term deposit funded from its savings.
A guaranteed return schedule. That's interesting. But it's also a big commitment, right? 318 crores from reserves, plus the ongoing 9% dividend payout, plus the eventual redemption cost.
Absolutely. It's a significant financial commitment over the next 5 years.
And that ties right back to the point you made earlier about cash flow and funding.
Precisely.
Yeah.
That's the synthesis here. You've got this picture of Siyaram delivering really strong growth, impressive margin gains, helped by good market conditions, but also seemingly by internal efficiencies.
Right.
Then, strategically, they're making these big, bold bets on future growth with Z-Code and Devo Fast Fashion and ethnic wear. Very focused niches.
And funded internally.
Funded internally, yes.
Yeah.
And at the same time, they're executing this major structured shareholder reward, the CNCRPS, which also draws heavily on their internal capital, their reserves.
Okay, so pulling it all together. Strong performance, aggressive expansion, generous but complex shareholder rewards, all happening while H1 operating cash flow was negative.
Exactly. And that leads us to the final thought, the thing for you, the listener, to really mull over.
Yeah.
You see this aggressive expansion. Remember, about 35 stores planned this year funded internally. You see this 318 crore CNCRPS bonus scheme drawing on reserves, which locks in future payouts and redemption. So the question is, given that negative operating cash flow in H1, which suggests maybe working capital needs are high with this growth, how sustainable is this? How will funding this expansion and servicing these preference shares impact their ability to keep improving margins, to keep generating cash, and to fund future growth waves without eventually needing to tap external markets for funds?
Right. Can they maintain this high level of internal financing for both growth and shareholder returns, especially with those fixed redemption dates coming up in 3 and 5 years? That's the real tension to watch.
It's the fascinating challenge for Siyaram 2.0 going forward, a real test of their operational strength and financial discipline.
Definitely something to keep an eye on. Keep digging into those reports. Thanks for joining us on the deep dive, and we'll catch you next time.